In this week's video, we'll review the latest charts to help us understand why the facts say the stock market's risk-reward profile is attractive. We'll be covering a set of annual charts and the normal disclaimers apply. And as always, we'll be looking at new data, new charts, and new signals and asking ourselves, do they align with or contradict the bullish hypothesis that was formed in January of this year? It's a monthly chart of the Dow Jones Industrial Average. In recent videos and in recent weeks, we have covered bullish MACD crosses on the monthly chart of the S&P 500 and the NASDAQ. Logic would tell us if our bullish hypothesis was accurate, and since the three major indices in the U.S. are highly correlated, we would expect the Dow to follow suit. And that's exactly what's happening, or at least attempting to happen, in the month of November. November 26, 2019, we're getting a bullish MACD crossover on the monthly chart of the Dow following the October 2018 bearish cross. Black has been below red for 390 calendar days, and that's significant. Why? Extremely short crossovers and extremely long crossovers. So let's say one was 9 days and one was over 1,000 days. Cases that are similar have similar psychology and similar shifts in asset allocation. So if we could find another historical example with 390 calendar days, the psychology of investors down here would be somewhat similar, and the psychology of investors up here would be somewhat similar. And the propensity to raise cash would be similar between this point, and the propensity or desire to move to more defensive assets in here would also be similar. This bullish cross here is trying to take place well above the center line, and this tells us that this is most likely a normal and 100% to be expected counter trend move within the context of an existing bullish trend. That's also relevant because it aligns with our hypothesis that this was potentially a cyclical low within the context of a secular trend. Given this chart is dated November 26th, we're not assuming anything. We may or may not get the bullish cross this month, but if not, the odds say that it most likely will come soon, if that's the case. How many similar cases dating back to 1948 and what happened next in the stock market? We painstakingly went through every single bearish and bullish MACD cross for the Dow Jones Industrial Average dating back to 1948. And then we found the cases that are similar in terms of the number of calendar days and similar in terms of this cross taking place above the center line. There were 9 similar cases on the Dow Jones Industrial Average dating back to 1948, 1 year out from the date of the signal, which basically would be the end of November of this month in the present day. If it holds, 100% of the cases, the market was higher a year later with an average gain close to 19%. 2 years later, 100% of the cases positive with an average gain of almost 38%. Also noteworthy, 5 years later, 100% of the cases positive with a median gain of almost 93%. It's very, very difficult to look at this table and this signal and say that it contradicts anything that we've been covering incrementally since roughly the 3rd week of January. This area in here is also constructive because it tells us to keep an open mind about some type of cyclical pullback occurring again in 1 to 2 years, and then possibly a resumption of the secular trend. If you're relatively new to these videos and this type of table and these type of projected returns or hypothetical returns based on history, if this seems ridiculous, is there anything else that would support keeping an open mind about better than expected outcomes? Let's look at an annual chart of the Dow Jones Industrial Average. We'll go back all the way to 1926, and in this case, we'll be using PPO, which is very, very similar to MACD. It's a momentum oscillator. You can pause your video player and read these bullet points. to gain a better understanding of why PPO is much, much better in terms of looking back literally decades. When we perform these studies, we walk forward on the chart and we find the first year where we move from black being below red to getting a close at the end of the year with black being above red, which is very, very similar or basically identical to the concept of a MACD bullish cross on any time frame. Fractals tell us that anything you know about MACD on a daily time frame basically applies to PPO on an annual time frame, taking into account these known and advantageous differences in this case. Bullish cross comes at the end, the last day of 1946. And after that, really good things happen for a long period of time. This is our secular trend here. These are cyclical pullbacks. From the last day of 1946 to the daily peak that was made on February 9th, 1966, the Dow tacked on an additional, that's an addition to this gain here, 439%. The S&P 500 over the same period tacked on an additional 515%. You can see this is our waning momentum look. Pay closer attention. Black is starting to come down to red. We eventually get the negative cross here, get the consolidation or sideways period that ends with a devastating bear market. This is the peak to trough loss on the S&P 500 chart from the peak in 1973 to the daily low in 1974. It's pretty easy to see that PPO in this period here, when good things happen, looks quite a bit different than PPO in this area here, where it's frustrating, volatile, and eventually leads to a devastating drawdown. This is visual evidence that we can see at the early stages of the secular trend. This is visual evidence, waning momentum that we can see before really bad things happen. Secular means long term. I think we would all agree that 19.1 years or 6,980 days would fit the bill. If we walk forward, at the end of calendar year 1984, we get a very, very similar look to what we saw at the end of 1946. Given what we know, we would hypothesize that this would be the early stages of a secular trend. And that's exactly what happened. PPO in this region looks similar to PPO in this region. This looks very similar to this. In this case, our secular or long-term trend lasted 15.2 years from the date of the signal, or the last day of 1984. The Dow tacked on in addition to this gain, 817%, and the S&P 500 tacked on an additional 813%. This look here, starting to look a little bit like this look here, or a look of waning momentum. Thus, we might logically think, if this A to B move was followed by a period of consolidation and eventually a significant drawdown, then this A to B move, similar look here, might also be followed by a period of frustration and consolidation, and in this case, two massive drawdowns. Pretty easy to see that PPO in here, at the early stages of the secular trend, PPO in here, at the early stages of a secular trend, looks quite a bit different than PPO in here and PPO in here. Therefore, the million-dollar question is, if we walk forward, does PPO in the present day look more like this concerning look here or more like this constructive look here? The answer is simple. It looks like the constructive periods. This period here is very, very similar to the look at the end of 1946, very, very similar to the look at the end of 1984, and that would be from an indicator look perspective and a price perspective. Therefore, we know what happened after this point in 1946. It's right here. We know what happened after this point at the end of 1984. It's right here. Therefore, we could logically extrapolate forward from the end of 2017 using the average gain for the S&P 500 and the average number of calendar days and determine, hypothetically, if the pattern holds. This looks like the early stages of a secular trend. It was. This looks like the early stages of a secular trend. It was. This looks like the early stages of a secular trend. And if the pattern continued and we followed the average path of these previous cases, hypothetically, the S&P 500 from the end of 2017 would rally for an additional 17.1 years, which is the average of these two numbers, or 6,271 days, which is the average of these two numbers. And of course, this is hypothetical, purely hypothetical, and for illustrative purposes only, but it's extremely interesting to note if you walk forward this amount of time from the end of 2017, it says in this case, wouldn't be shocking if the secular trend ended on March 3rd, 2035. And if we took an average of this gain here and an average of this gain here, that would be 664% from the end of 2017. Hypothetically, that would take the S&P 500 to over 20,000. Why is a chart of the Dow relevant for the S&P 500? Because the correlations between the S&P 500 and the Dow and the S&P 500 and the NASDAQ are extremely high. For the most part, especially over longer periods of time, they zig and zag together. They're in secular trends at the same time and in bear markets for the most part at the same time. Now, one of the extremely interesting takeaways here is we arrived at March 3rd, 2035 by simply using these returns and these returns, this period of time and this period of time, based on basically price and the indicator. I think it's logical to say that that would bolster our bullish case if we recall that 2035 is also the date or year that we arrived at using a totally different analysis. This is the title slide, I believe from October 8th, 2019. The demographic trends in this video would apply basically to any business or any walk of life. If you want to find the video, you can Google this title here. If you have trouble finding it, add our last name and or the name of our blog, Short Takes. 2035 is based on demographics and spending patterns and the fact that as time goes on, the millennials will move in this direction and become more relevant, and the baby boomers will move in this direction and become less relevant. In the last year of the demographic sweet spot for spending and income patterns would be 2035. Interesting to note. For the baby boomers, it was the year 2000. Here's the year 2000. To the right of the year 2000, really bad things happened for the most part for a long period of time. To the left of the year 2000, when we were in the demographic sweet spot, really good things happened for a long period of time. So if we put the demographics on the chart that we just looked at, the demographic analysis told us that 2019 was very, very similar to the 1984 to 1987 window. Here's the 1984 to 1987 window. Look at the indicator, basically identical to the present day. Look at the price pattern. Long-term consolidation and a bullish breakout. Long-term consolidation and a bullish breakout. It's very, very difficult to say that anything on this page, including this new projection here, contradicts in any way the bullish hypothesis that was formed around the third week of January with the similar breath thrust post. That's the title of it. You can find it by Googling that title with Short Takes and or Shavako. And it's also hard to say that anything on this page contradicts the thesis that we are at the early stages, the relatively early stages of a secular trend, and we have just come off of a cyclical low. The signal that we just received also tends to confirm that. How does it do that? If we just had a cyclical low, then it wouldn't be unusual for the market to rally for 1 to 2 more years before reaching another cyclical peak. And you can see in here, and as you can see in here, from year 2 to year 3, your average gain only goes from 38% to roughly 45%. It's telling you there's some consolidation or pullbacks in here. And from year 3 to year 4, your median gain actually drops. So this is your cyclical rally. Somewhere in here you get consolidation or a cyclical pullback, followed by another cyclical low, and then the returns start to take off again. It's a big, big jump from the end of year 3 to the end of year 5, a big, big jump from the end of year 3 to the end of year 5. Not really the case in here. It starts to slow down. Visually, that would be, this is your cyclical pullback. The secular trend resumes. Cyclical pullback, secular trend resumes. Cyclical pullback, secular trend resumes. What about valuations? Answer to that question was covered in detail in the demographic video. In a nutshell, if we look backwards from the end of 1982 all the way back to 1881, the median Shiller PE was 14.8, telling us at this point here, looking backwards, stocks look relatively expensive. And in here, stocks look relatively expensive. When you're here, you only know what's behind you. You have no idea what type of multiple expansion that you could see in the future. As we were walking through this analysis, you might have logically thought, Chris, that's only one indicator. You can't draw all of these conclusions based on PPO. Since the CCM market model uses a weight of the evidence approach, we would tend to agree. Keeping in mind, this analysis used PPO. We did a very, very similar analysis using the S&P 500 a few weeks ago. That analysis used a total of 9 indicators. One of them was PPO. So we have 8 additional indicators, including the Koppel curve, Williams percent R, rate of change, ADX, RSI, Bollinger Bandwidth, CCI, and the True Strength Index, that all are basically singing off the same bullish and demographic hymnal, which speaks to the weight of the evidence. It's a holiday week. You can pause your video player if you want to read some of this. We basically agree with JP Morgan when they say 2020 could be the year of the great rotation. Retail investors abruptly shifting away from bond funds to buying equity funds, something that was last seen in the year 2013. And as it turns out, we've covered 2013 several times because 2013 is part of the breadth thrust story off of the low in 2011, the consolidation in 2012, and then a similar breakout to what we're experiencing in the present day to 2013. So from this general area in here, the S&P 500 tacked on an additional 46%, with a lot of it occurring in calendar year 2013, where my cursor is. JP Morgan is saying, based on this rationale here, that 2020 next year could be similar to 2013. We've been talking about a shift away from bonds for a long, long time. Several studies, August, June, there are others that we've covered as well, basically said that bonds should, from a probability perspective, underperform stocks. And that's exactly what JP Morgan is saying. Thanksgiving week, headline, U.S. new home sales post 2 best months in more than 12 years. Our hypothesis in both 2018 and 2019 that we've backed up with facts in these videos was that the U.S. economy from a probability perspective, should avoid a recession. Does the latest data align with that theory? Very, very similar to the permits chart that we covered in last week's video. New home sales also tend to peak well before a recession. Peak before a recession. Like this new high that we talked about last week, new home sales have also recently made a new cycle high. How about credit spreads? This chart is dated November 25th. We're at 4.08, way down here. Concerns about the economy and concerns about default are much lower today than they were in late 2018. Much lower today than they were in 2016. Much lower today than they were in 2011. And infinitely lower in the present day relative to the peak of fear in calendar year 2008. Like this data here, like this headline here, the latest reading in the credit markets is not screaming or aligning with imminent recession. Like anything else, that's subject to change. But we've been saying this for a long, long time about credit spreads. It hasn't changed yet. And often when the technicals start to turn and the fundamentals start to turn, you hear things like, well, things look good in 1987. We're going to crash. Now, obviously, we would never take a market crash scenario lightly, but let's check some facts about this hypothesis. We open the video with this. The S&P 500 recently printed a new bullish MACD monthly crossover. That is in the history books. The same thing for the NASDAQ. Now the Dow is trying to follow suit. If we look back historically, does this look here align with this thesis here? Said it in a more prudent and calm manner. Did we ever see a bullish monthly MACD cross on the Dow's chart during the 1974, 1987, 2000 or 2007 bear markets? Meaning, did we ever see anything like this, something that's happening right now in the present day? These are monthly charts of the Dow, 1972, 1986, 2000 here, 2008 here. If we fast forward with price, you'll understand why it's important for us to monitor this type of risk. Extremely painful declines. These are numbers from peak to trough for the S&P 500. Did monthly MACD for the Dow ever take on a look like this? The answer, a 4x, no, which simply speaks to probabilities. The probability of a crash is never zero. But the probability of something even like 1987 is not particularly high. Look how long we had a bullish cross in place prior to this. This is an extended market. Monthly MACD and price don't look anything like this. And this short takes post here, you can Google this title here, also shows that 1929, 1987, and the year 2000 have significant differences relative to the present day, which speaks to the probability of really bad things happening relative to the probability of really bad things happening in those previous periods. As we mentioned a few weeks ago, we've been active on Twitter for a long, long time, not so much on LinkedIn. We both wanted to send a gigantic thank you to those of you who have stepped up to help out thus far. We know many of you are busy. If you could help out in any way, that would be greatly appreciated. We still need additional connections. This number has come up significantly, and skills endorsements would be incredibly helpful. We have absolutely, positively no intention of proactively reaching out and marketing to anyone. All of this helps us with the algorithms in LinkedIn. It helps us with distribution, helps us with the search utility, also helps our work to be found via Google. If you can help us with this, we can continue to try to put out quality work and make it available to everyone. Let's talk a little bit about risk and reward and opportunity. If you've been thinking about having us manage one of your accounts, now may be a good time to make that happen. Why? Probability of good things happening over the next 2 years from numerous data sets is favorable based on numerous signals that we've covered in recent weeks and months, signals that we have in hand, things we can see, measure, and put in a model. From a price perspective, we also have a bullish breakout, and we know what once acted as resistance, may now act as support. The further we get away from this base, the harder it is for us to manage risk. This is the type of look and concept that sparked this title, along with this concept here about new all-time highs. You can pause your video player. This title here also speaks to remaining close to a long-term base and having a high probability of moving away from the base. This study here that we just covered tells us it's not unreasonable or crazy to think that the S&P 500 and the Dow could be up to 30% higher 2 years from today. That means 2 years from today wouldn't be all that unusual for the S&P 500 based on what we've seen and based on history to be trading over 4,000. The closer we are to the base, the better the risk-reward profile. Why? If we buy here and it fails, we know it very, very quickly. We're near a base, something that just happened, short takes post. 100% of the cases were higher 2 years later. 100% of the cases were higher 3 years later. Something we've just seen and what happened historically aligns with the title of this week's video. Something we've just seen and what happened historically aligns with the title of this week's video. Clients and regular viewers know these are extremely important concepts. Maximum flexibility day by day. If the facts in hand change, we must reassess the probabilities. Another thing we agree with relative to JP Morgan, we've said numerous times this year, it doesn't look like institutional investors have been selling or in any hurry to run for the exits. Typically, the institutional investors buy early and the retail investors fall in behind. JP Morgan, this suggests 2020 could be another strong year for equities driven by retail rather than institutional investors. From a risk management perspective, we will continue to look at new data and new signals and test our hypothesis. Think about all the studies we've done and all the tables that we've shown since January of this year. The weight of the evidence tells us unequivocally right now a favorable probability window is still open. We can continue to assess that in a prudent manner as long as we keep that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.